Greetings, Jonathan Camarda. Hopefully everyone's got off to a good start to their summer here. Been a couple of weeks, so let's get started. Well, the S&P 500 has been working, while we've been off camera here as the S&P has entered new bull market territory, which is signaled by 20% above its lows there in October. So pretty good bullish signs out there. Some caution as well. So let's get rolling. Let's get started with some of the details. NASDAQ, of course, has been leading the way. You've had technologies, discretionaries, communications, which, again, a lot of your strategies are heavy in, like Global Macro, Velocity Raptor, and even recently the opportunistic growth and income strategy as well. Took me a second. And a little rusty and the such. And so what you've seen here is, again, is the breadth of the market, right? You hear that all the time on TV. We're not talking about, did we use Listerine? We're talking about the width, the depth of the actual strength. And a lot of the bears on there, we see them on TV. They come out all the time, whether they've been short since October and in pain. And as such, they've been calling the lack of breadth a canary in the coal mine. But just last week, we saw the Russell 2000 small caps, okay, get out of bed, along with mid caps, and grab their lunch pail as both went up above their 200-day moving averages. So now you have the rally widening out. Now, not to be Pollyanna, because it's not, we don't paint this thing in shades of white or black, but more shades of gray. Volatility under 14, the volatility index, first time since we went back to pre-COVID. And so a lot of folks say, well, this could be a stick of dynamite ready to go off. And there is some room for caution, which we'll get into. However, the volatility index can stay at low levels for years. It did it pretty much almost a decade from 12 to 20, I guess 9 years there. And it certainly post the tech bubble into the financial crisis as well, where it stayed subdued. Now, we're not calling for that here because we think because of the Fed and distrust of the Fed by the public, which we'll get to as well, there is some room for volatility. Although right now there's, basically economists looking at only a 25% chance that rates are going higher from here, 75% lower. So let's get into what the Fed's been doing, right? They've been playing a little run-pass option. Of course, they've been on their quantitative tightening, right, where they're selling their securities. So when they're selling Treasury bills, that actually tightens credit, right? That's where things become a little bit more difficult to gain credit and as such. And when they're buying instruments on what they call open market activities they're actually increasing liquidity. That's when money is a little easier, et cetera. So, but here's a bifurcation. They've been selling on the open market securities, tightening up their balance sheet, but they've been fattening it up on the emergency side with some of the bank failures, et cetera. So it's almost a kind of a balance where they have loosening and tightening, where they have been buying a lot of bills out there as well on the emergency side and then tightening on their general side. So what we really see here, though, is a problem for the Fed is an increase of flow into these money market funds because, again, distrust of banks, and banks don't really pay much, as people are starting to find out. That's another risk that's out there for banks. And, of course, we've been in the high-yielding money market funds, your SNOCs, overnight Federal Reserve Treasury fund, back to last year, okay? We were quick on the fastball there as far as making those moves, but you have a lot of institutional money and individuals that have been flowing in. Now, what we did, though, is when the market had some high volatility late last year, nobody knows when it's hitting the bottom there in October, we had a lot of money there as a hedge. And, of course, early this year, we started putting a lot of that money to work because those money market rates will not last as rates come down, which they will, as we've already been in a rolling recession. We called it last year. Now, recession doesn't knock on the door. Generally, pardon me, you don't see a recession until you look through the rear view. Say, oh, that was a recession. So a lot of people that are saying soft landing, et cetera, well, we've already kind of been going through the mist. When you look back, you'll see that that's what it's looked like. So what does that say going forward? Well, again, there are rooms for caution. This is a seasonally tough time of year. However, the market has just started to waken up on some of those broader scales, from that standpoint. Now, that's not to say that we couldn't have a pullback, especially in some of these overbought areas, AI, artificial intelligence and all the buzzwords that are out there. Actually, AI has been around for years, folks. In fact, in our business, machine learning, been around for years. We've been talking about program traders driving markets for a long time. However, the boom in some of these companies that a lot of you own, very pretty, won't go into individual names on this cast, and as such, you're all right for maybe somewhat of a pullback, but now you have other sectors that are picking it up. Your real estate, your industrials, all these other sectors now that are starting to pick up the strength, from that standpoint. So we shall see. It is an interesting dichotomy on a seasonally weak time of the year. Volatility could be there. The Fed, are they going to hike? Well, we almost forgot about this week, didn't we, with the Fed? So again, a lot of folks think they're going to pause this week and then probably continue in July. A lot of folks say just get it over with because they're coming to the end of their road, to go that 25 or maybe out with a boom for 50 basis points. Almost ludicrous if they go 50. And here's something I want you folks to do as well, is we always advocate education, right? We're always telling you, do your own homework. We like a smart client. So if you look at when inflation, the government stats have it at like 4.9, just under 5, right? The roof's right here at 5, and they have it at 4.9. Go to a site called Trueflation, okay, where they actually look at leading indicators, a lot of lagging indicators, these employment reports, et cetera, and the such that you see on these with the jobs numbers, et cetera, and the Fed driven by some of the data that they're looking at. Trueflation.com has inflation at 2.75, which gives us even more conviction that the Fed is coming close to the road. Because don't not believe, there's a double negative on you there, that they're not really looking at those numbers as well. And they've realized that that brake pad of their ability to continue to tighten is getting awfully thin. Like that that sponge you're supposed to throw out, get rid of it, get the new sponge out of the bag there, even with the cost of inflation. and as such, that brake pad's getting thin for how much more they can hike. With that being said, lots of reasons to be positive. S&P, like I said, is in bull territory. It's rebounded 20%. Naysayers can say what they want. It's a fact. NASDAQ obviously has already been outperforming. The Dow Jones lagging, but it outperformed last year. Still, again, pullback might be expected this summer. So again, we do want to keep our foot near the brake pedal, but at the same time, many of you, nice big smile on your face. If you're looking at May statements and as such, that again, we've been telling you this all the time, is that we want to keep the skis in front of us with our head on the old swivel there, but at the same time, not listening to all the noise, the white noise on the big three business channels behind me. Those are on moot entertainment purposes only, kind of. Until next time, Jonathan Camarda, take a dip on me. Stay cool out there. Chillax, as they say, up in New York and the Hamptons this time of year, I think. Been there in a while. Otherwise, stay frosty, and until next time, we'll talk to you.